These are the solutions for the 4 questions of Quiz 2. Now, question 1. Mad City Flash sells computers and video games. Okay. The business is divided in 2 divisions among product lines. Variable cost and income statement for the current year are below. So here's for computers. $800,000 in sales, variable cost $480, contribution margin $320. VG Systems, $200,000 sales, $140 variable cost, contribution margin $80. The total is $1 million. So the $1 million sales, 800 is computers, 200 is VG. Okay, now we're asked to determine the sales mix and the contribution margin ratio for each division. So the sales mix for computers, I'm just going to put C here. For computers, that is 800,000 divided by 1 million, or 80%. So 80% of sales are computers. VG, whatever the VGs are, 200,000 divided by 1 million. So therefore it is 20%. So that is the sales mix. That's 8-part sales mix. Now, they also want the contribution margin ratio. That is the percentage of the contribution margin of sales. So for C, that is equal to 320,000 divided by 800,000, and that will equal 40%. And for VG, it will be 60,000, sorry. 60,000 divided by 200,000. And their contribution margin ratio is 30%. So this is the contribution margin ratio. Now they ask for us to compute the company's weighted average contribution margin ratio. So I'm going to use the sales mix and the contribution margin ratio. So therefore, the weighted average contribution margin ratio is equal to 80% for computers times 40% contribution margin ratio of computers plus the sales mix of VG, 20%, times the contribution margin ratio for VG, which is 30%. And that then equals 38%. Now they want us to calculate Now they ask us to calculate the break-even point in dollars. Well, the break-even in dollars is going to equal the fixed costs divided by the weighted average contribution margin ratio. And the fixed cost is $228,000, and the contribution margin ratio is 0.38. So the weighted average break even then is $600,000 in sales. Then they said, okay, tell us how many is computers and how many is VG. Well, computers then would be 80% of the 600,000, or 480,000. And VG would be 20% of 600,000, and that therefore would equal $120,000. So that's the break even for each of the products. And that's how. Okay. Oops. Now, question 2. Clingy company budgets the following unit sales. So there you have the sales for January, February, March, April, and May. Each unit requires 2 yards of fabric and is estimated to cost $3.50 per yard. It is the company's policy to maintain a finished goods inventory at the end of each month equal to 20% of next month's anticipated sales. So that is our production budget down here. So if we look at the production budget and take a look at it that way, this is how we would calculate that. For the month of March is what we want. All right, so the expected unit sales then would be 11,000. Desired ending inventory would be 20% of next month, so it's 20% times 16,000, which would be 3,200. Total required, 14,200. Less beginning. Well, the beginning would be 20% of 11,000. So 20% times 11,000 would equal 2,200. And therefore, the required production would be 12,000 units. Okay, so that completes that one. Second part of the clean company has a policy of maintaining raw materials inventory at the end of each month equal to 10% of the yards needed for the following month's production. There are 1,200 yards of fabric on hand March 1st, so that's my beginning inventory. So let's take a look at this now. If we could turn it a little bit, make it bigger. There we go. So, units to be produced, well, we know that is 12,000. Direct materials per unit, there's 2. So therefore, total yard, 24,000. Yards are needed for production. Desired ending inventory in yards, well, that's going to be 10%. I should put that down here, the asterisk, okay? That's going to be 10% times 16,000 plus 20% times 13,000 minus 20% times 16,000. Now that's a lot. That is hard to calculate, and that comes up to 1,540. So the total amount required then is 25,540. Less desired beginning inventory, well, we calculated that down here. That's that one, which would be 1,200, or they told us it was going to be 1,200. I'm sorry, it's not that one. So therefore, direct material purchases would be 24,340 yards, and we pay $350 per yard. So therefore, the final answer is equal to $85,190. Okay, so that's how you go about the direct material budget. It's a little more complicated than the production budget. Oh, what did I do? Okay, question 3 then. We have Carlson Company has budgeted sales revenue for the next 6 months. There you have January, February, March, April, May, and June. Past experience has indicated the collection of credit sales occurs 60% in the month of sale, 35% in the following month, and 5% in the second month. Prepare a schedule showing the cash receipts only for the month of May. Okay, so in May, I'm going to get May sales, April sales, and March sales. So March is going to be 5% times 64,000, which equals 3,200. April sales is going to be 35% times 56,000, and that equals 19,600. And May is going to be 60%, it's the month of sale, times 88,000 total sales in the month of May. So in the merry month of May, we're going to collect 52,000 $800. So the total then, total cash receipts, $75,600. Question 4. An investment banker is analyzing two companies that specialize in production and sale. Okay, Fireside is labor intensive and Sterling is more capital intensive. Variable costing income statements for the two. Sales, $1 million. Variable costs here, $600,000. Contribution margin 4. Fixed costs, $200. Now the same profit. Notice same profit and same sales. However, the variable cost for Sterling is $2,500. Therefore, the contribution margin is $750, and the fixed costs are quite a bit more. The fixed costs then are $550. Okay, so we have a profit of $200. The investment banker is interested in acquiring one of these companies. However, she is concerned about the impact that each company's cost structure would have on profitability, and asks you to calculate the degree of operating leverage and to determine the effect of each company's net income on sales if net income if sales increase 20%. You don't have to prepare the income statements. Okay, so the degree of operating leverage is equal to the contribution margin, CM, it's equal to CM divided by net income. So for Fireside, that would be $400,000 divided by net income of $200,000. And for Sterling Moments, the contribution margin was $750,000 as divided by the net income of $200,000. Sorry, folks. And so we have a degree of leverage of 2 for Fireside and 3.75 for Sterling Moments. Now we want the percentage change in income. Now the percentage change in net income, if Fireside's sales go up 20%, well, it would be 20% times the degree of leverage, which is 2. So their net income will go up 40% if sales go up 20%. For Sterling Moments, it's going to be 20 times 3.75. And so when you figure that out, if Sterling Moments sales go up 20%, their profit is going to go up 75%. So that's how you calculate the degree of leverage. Sterling Moments has a higher degree of leverage, and therefore it's going to show higher profits and higher losses if sales go down than will Fireside. So that completes this quiz. I hope that's helped you prepare for the midterm exam this Sunday.